first and foremost, I mean, we could start with the GameStop, and that is just up $200. But I think what's really interesting about this situation is that this Wall Street Bets crowd has really figured out that they figured out the short selling game, and they figured out that there's only a finite number of shares, and that they can push it to wherever they want. And in the event that there is no borrow, or the borrowability fails, then the shorts have to cover, and so they've pushed them to the brink here. The idea that that they can hurt a very, very large hedge fund, some of the best in the game, is foreign to most investment managers. How a retail group, but I mean, we've been talking about it for over 6 weeks now, how a group of a million, call it 1 million, 2 million now, 1 million, 2 million, a crowd, a mob, if they got together to actually buy stock, they can, buy 100 shares, 1 million people buy 100 shares, 100 million shares. You can destroy these shorts. You can destroy the computers. The computers, frankly, it's even more powerful because the computers don't have a emotion. And so they have rules. And so as you keep pushing a stock, the computer is just shorting. And then at some point it breaks and it reverses and has to get out. So there's that tipping point, if you will, on there's that tipping point on how the dynamic of the stock. We're selling, and then we're buying at higher prices. That's what you see in a GME. What you're also seeing at GME is that they figured out that they have become, instead of a price taker, they have become a price maker, okay, a price setter. Well, if you think about how you trade stocks, there's a bid offer, you're selling it, you're buying it. But if you are trying to, if you're thinking about forcing someone to actually pay a price, it's really a huge game of chicken here. But what they figured out is that they figured out that we can set a price at 1,000. We could set a price at 1,000, and if no one sells, we are the market, right? And hey, Mr. Hedge Fund, the market is not 350. The market is actually 1,000. If you want to buy significant amount of shares that you need to buy, well, we're here at 1,000. And I think that's powerful, that thinking. The hedge funds have also run into a crowd, a mob, for instance, it's a generation of holders, right? They have the will to hold, right? We've seen that in Bitcoin. So we've grown this generation of holders that are willing to withstand enormous volatility. Remember, we talked about Bitcoin. You take it from $1,000 to 20,000, 20,000 back to 3,000, 3,000 up to 40,000, 40,000 down to 30,000. These are massive moves and massive asset accumulation moves, dollar moves. Okay, and it's a generation that is willing to hold, and that is foreign to most people on Wall Street. When it's down, you sell. When you get out. And the ability to force people out and to scare people out has always been a game that the big guys have played, the market makers have played. This crowd is hard to shake. Okay, it's hard to shake. And if you go on Wall Street Bets, you can see they're all in it together, which is amazing to see, right? It's incredible, right? I sit here thinking, man, I'm not part of the crowd, but I feel like I'm helping them sharpen their tools and just saying, here, you're using sticks. Here's a stick with, like, you see this metal piece, go nuts, and talking strategy and saying, they're trying to do this to you, trying to do that to you, and this is how you can protect yourself. So, I see what's happening here, and I see you're talking about young investors making a lot of money. There's no doubt, and it's awesome. So I start thinking now all I'm thinking is, how does this end? How does it stop? Does it stop that this group has made a fortune? Okay, so 1 million people. Just do the math. Say 1 million people make $10,000, and obviously some people have made fortunes. Some people not as much, but you're talking about billions of dollars, billions of dollars that have been made by the crowd, which does what? They make money on Tesla. They take that money, they parlay it on GME, and you're talking about multiple times of people's money. So that is creating more dollars, which gives them what? More power, right? More dollars, more power. And then they go, and it's not that they are just, oh, I'm just going to do this. They've become empowered, and they're saying, you see that one right there? We can take that guy out. And now they're attacking. I think it was 4 weeks ago, 5 weeks ago, we put hedge funds on notice. If you're a hedge fund, you're watching this, you're on notice. If you're short a stock, you got to be very careful, very careful. Okay. So I think hedge funds are feeling the pain here. They're jumping in. You jumped in at 150 because GameStop should be worth 20, 30, 40 bucks, whatever. The thing is up $200 since you're in there, right? Today, in one day. And again, what if the crowd doesn't want to sell? They want to hold to 1,000. There is no price in between. It could keep on catapulting higher and higher. Okay. So how can this end? I've been racking my brain thinking, one, how does it end? How does the Wall Street Bets crowd get hurt, or how could it stop, or how could this game of momentum reverse? And I came up with two things that would not be impossible to implement by the powers that be, and it could happen quickly. They might even already be thinking about it. The reason the reasoning behind what they would do is they would simply say, this can cause instability. Clearly not for the Wall Street Bets crowd, but for the overall market. You see in the last week how the volatility has increased. So when GME starts going up, okay, a large hedge fund, 13, maybe it's 13, 15 billion in assets, leveraged, he loses in one position. And one position becomes a domino effect on the other positions. And then when people start seeing that he's losing on 10 positions, they attack 100 positions of his, and they push him sort of off the cliff. Mm-hmm. And then they find the next hedge fund and they start doing, well, the hedge fund community has hundreds and hundreds of billions of dollars, maybe it's like a couple of $1 trillion. You cause instability with a couple of trillions of dollars. You can get panic selling. You can get people to come out of a trade. Hey, again, for the Wall Street Bets crowd, that's okay. But the government, the Federal Reserve, the government is watching the overall market, and they don't want instability in the overall market. They don't like volatility increasing in the overall market. It damages a lot of things outside of just the market. And so what could happen? The first thing I think that I think the crowd, Wall Street Bets, should watch out for is this chatter of them increasing the amount of money you need to have in order to trade options. Right now, you can open up an account with nothing, a few $100 and start trading options. They might say, you know what, you're going to need 10,000 or 20,000 over the next 6 months. Like, we're going to change the limits for 6 months to see what happens. We want to make sure this, the volatility calms down. We want to make sure the markets are working correctly and everything is fine. So that's number one. They can just change the limits. So if you don't have 20 grand, you can't trade options. You don't have 10, whatever that limit is. Okay, mm-hmm. That's one. Okay, remember we have a situation where there's, call it 50 names, maybe it's less, but let's call it 50 names that have enormous amount of retail investors in these names. And there's enormous amount of leverage going on in this small bubble. Okay. That bubble also has hedge funds, and those hedge funds have outside investments outside that bubble. They're long General Motors, they're long Pinterest, they're long other things. Okay. So affecting the bubble has an effect on the outside world, on the outside investments. And so trying to knock this bubble down, which is causing a knock-on effect on the rest of the world, they would accomplish this reduction in volatility. So you can increase the limits of whether or not we're going to allow you to lose options. And if that happens, you're going to see people have to sell. They're only going to be able to sell their options, which would put pressure. Usually they're in calls, so it would put pressure on the stock. Okay, that's one. The second thing that they can do, which is in the same vein, is simply say, we're going to increase margins. So we were giving 50%, we're going to increase it to, we're going to reduce it. We're going to increase the amount that you have to hold. So we're going to reduce the leverage. Reducing the leverage of the bubble will decrease that bubble. Okay. Decreasing that bubble can do the effect of tipping it over to the other side. We talk about the mountain, from one side of the mountain to the other side of the mountain, where, you know, I look at GME and we have to remember there is no 300 bid by an institution. The stock's trading 330. There is no 250 bid by an institution. There is no 200 bid by an institution. The bid is probably, for a real buyer for GameStop, is probably around where it started, $20 now, 15 to $20, saying, okay, I can believe that it's worth here. Maybe it's even lower, the real value bid. Okay. That doesn't mean it's going there. It's just saying that in the event that this turns the other way, that all the shorts who are basically buying this and in this whirlwind, right, tornado of, you know, buying and selling and getting caught in a short squeeze, and another 150 points, getting more puts, trying to buy puts, even though puts are not tradable right now. So I would say just getting more stock and trying to short it. You know, there's this real issue that, you know, the mind sort of understands it, but unless you feel it, you it's almost like you don't understand it, right? You have to feel it. You look at something at 330 and you're like, well, you know what? I might just sell 250. If it gets down to 250, it might go from 330 to 250 to 150 to 80 in a heartbeat. And that brings up the next point. Like, what else could actually happen? And what something like today would happen. Today, you know, why is it, you think it's coincidence that every one of these brokers has trouble when it's like huge volatility days? Right? It's not good. They all aren't plugged into the same wall with the, you know, a little plug and okay, now we're ready to trade. You know, what I think, I don't think they would say this, but what I think happens is that they're protecting themselves, because as the market's about to open, they want to make sure what? That they're protected. Meaning, you know, if someone has a huge account and they, for whatever reason, are blowing up because the market is trading wrong or against them, they, you know, maybe there's 1 million accounts. They might say, you know, 10,000 of these accounts are looking like they might be blowing up here. We're going to actually get out of all of these positions. We're going to knock those 10,000 out. And that takes, you know, it takes coordination. It takes some time, and it takes them. We're going to look at not only them, but we're going to look at the rest of the portfolios. Once they have that under control, it's sort of, then they sort of, you know, allow people, okay, open up the gates and let everybody. A bit more. Yes, there's a lot more people trading and things are going haywire.
Your mic broke down a little bit. Can you just adjust it? Yep.
How about right now?
Oh, it's still a bit messed up.
Let's see. We'll try one more time here.
Okay. Yeah, guys, let us know in the comments below what you think. This is really interesting. Great topic. I'm going to ask Felix some hard-burning questions. And if you have some, please make sure you comment down below. And I'm going to make sure to ask him, because it's wild. And he's a true expert that has worked on Wall Street through multiple crashes. So it's going to be interesting to hear his perspective. All right, Felix, can we hear you now? Can you hear me, Felix? No? Can you hear me? Something broke down. Let me just send him a message real quick and see what's going on. Hi. Okay.
Can you hear me?
Comments.
No?
Yes, I can. Yes, I can. Hear you. Yeah.
Okay, I can't see me, but I'll just talk and you guys tell me if you can hear me or not. But essentially, you know, trying to pick off where I was, I'm thinking, where were we? Okay, well, I'll try to adjust the mic and I'll go here blind. But the idea is that, you know, these things break down, the brokers, they break down at a time when we need them the most. And so if you can learn one thing, you got to learn that the impossible could happen, right? That the impossible could happen, and that you have to be prepared for that.
Okay.
You have to be prepared for that, and you have to have have. So I always talk about exits and getting out of situations, getting out of your stocks, and having that first 100%, able to get out of that first 100%. You know, if you had that today, then you were prepared. If you didn't, then it's something to think about and something to actually perhaps implement when you're thinking about putting a trade on. But for Wall Street Bets crowd, keep in mind there might not be a stop. It might be 350 to, let's say that the federal government implements these plans and it's 50 to 350 down to 100 in an hour, and Robinhood is down for that hour, or E-Trade, TD Ameritrade, everyone's down. How do you get out of that position? And then you get knocked out because you're long calls and calls go to zero, and it's a disaster. So I think it's very important to fully understand what might be a potential disaster and what could go wrong. Why don't you do me a favor and tell me? I'm sorry, I'm not sure if you can hear me. Can you hear me still? Yeah.
Yep.
Okay. Can you see my screen, by the way?
Yeah.
Let me see. Can you? Yeah. All right. So let me talk through my screen because I'm frozen. So if at any point in time you can, I'll take you. Let's look at. Why don't we look at something like Nokia or something like that today, because Nokia is up there. It looks like it's probably halted here.
Okay.
So maybe see which ones aren't. AMC. If we look at AMC here, stock trading up $16. This might be. Let's go here. Let's go to the Februaries and Marches. I mean, things are so haywire here that the strikes aren't even available. So, but if you look at what's trading, and we look at the board here, we see all of these crazy names, and I think it's just important. It's very important that we understand that I'm going to be the first to tell you, I don't think trading in the options, in any of these options, for a period of more than 48 hours to 72 hours is probably the right thing to do on any of these crazy bubble names, because the reality is that the volatility and price is way too high. This has become a complete momentum game, and the not only that, but trading around these stocks, okay, call it the top 20, that even the ones that you see in this list, trading around these options, okay, you have bid offers that are a dollar wide. So the way to calculate that, the way to think about that, so you appreciate how much money can be made or lost just on bid offer, is if the options cost you $5, okay, an at the money option costs you $5, and you go and you try to go buy, say, a 10 lot. So it's going to cost you $5,000, and you got a cross bid offer. There's what's called a delta. So most people are familiar with probability of bidding in money. Delta is very similar. So let's just say that the delta is 50%. On a 50% delta, with a dollar wide bid offer, assuming that you got to cross a dollar wide, then you got to actually, that option, you have to actually make $2 to make back that sort of dollar wide. The stock's got to move $2 for you to actually just break even by crossing bid offer. And that is a general thing to look at. You look at it on a delta, and you're essentially buying stock with a bid offer of $1, $2 wide. It's not something that I think you can make money on long term. First of all, day trading just in general is hard. You're going to be right 50 to call it 54% of the time if you're really good, and trading bid offers of $1 or $2 is probably detrimental to your portfolio over the long term. So my advice would be to find the names that you like, position yourselves to take a risk reward bet that could pan out or not. Know what you're risking, and then and not trade this for 30 cents or 50 cents. Trade much smaller, and these are supposed to make big moves because they have 150, 200, 300, 400 volatility. They're supposed to make big moves. So you want to reduce the position size, and then actually not trade it as much. Try to stay in the game a little bit longer, waiting for your position to play out. I apologize. My computer froze here. I'll let Marco ask me a question. Marco, you can ask me a question here from on the chat here.
Okay. Yeah.
And I can read the chat and I can help you guys out.
Yes. Yes. Okay. So guys, I'll say the question. I'll type it in as well in the chat. So, okay, what could the Fed do in this type of situation? I'm interested.
What could the Fed do?
Right. Right.
Yeah, I mean, I think the Fed is part of the implementation of lowering volatility. I think, listen, in 2009, I would have never thought that they said you couldn't short a stock, and I don't know if a lot of people know that, but there was literally a moment where they said you could not short a stock. So, could they say that you can't trade GME, or we're going to liquidate GME positions? Could they do that? I don't see why not. I mean, they can do anything they want, but I'm telling you, when I first heard 2009 was happening, the market was starting to collapse, I was very short the market. I was like, this thing is going to collapse. And I remember that day because I got really burned in a period of 24 hours where there was a rumor that they were going to not allow you to short, which meant you weren't even allowed to buy puts. You couldn't short and you couldn't buy puts, which, I mean, I couldn't even understand what that meant. With being in the business for 15 years at the time, I really couldn't understand what that meant. So I wasn't allowed to short. I'm not allowed to buy puts. What if I own puts? Well, you're only allowed to sell the puts long, and really the bid offer was 50 cents at $5 or 10 cents at $20. There was no market, and so they could, if they wanted to. Why couldn't they say, you know what? If you have GME, we're gonna reduce your positions, or we're gonna, again, they could start by saying we're gonna reduce the leverage. By saying you're gonna reduce leverage, we're not gonna allow any leverage in GME, right? Without any leverage in GME or AMC, they'll list a name of 20. That will cause people to sell. Okay, so just that by itself might knock GME down 100 points, because whoever has leverage will not be able, if you're on a cash account, then you can actually, keep your GME. But if you have any leverage, then and you own GME and you think you bought it with cash, they'll just take you down there. So that's something that they can do. And I think that's the main dial that they could just try to push, put out a note and say, look, no more leverage. And I think the bigger one that would hurt the worst is the one where they say, if you don't have 10,000 in the account, you can't trade options. Like, that could be the second one. And they might just say, look, it's going to last for two months or 3 months. We're just going to, calm things down. We don't want people who don't ever use options and just are learning and just buying. They don't really understand the risk. And they might say, we're trying to protect them. So this is something that yeah, I mean, anything to cause a little bit of selling. A little bit of selling can cause an enormous amount of selling. Okay, what's the next question?
So I was going to ask you as well. So if people, keep piling up their positions,
question is,
you can read it.
How can people sell their positions? Who is the buyer at that price point? Other Wall Street bet traders? Is this a recipe for a crash? Again, it's. I can't be clear enough. There is no buyer in some of these names. There's no real buyer. You're talking about the way markets work. It's supply and demand at certain price points. So, a lot of people don't recognize this. When they talk about market cap, you have a stock that's $100, and you have bids and you have offers, you have buyers and sellers, and that's why the stock is at $100. If for whatever reason you're the only person in the market and you pay 110, okay. Let's say the market cap for that company is $100 billion, and you pay 110 for one share. That 110, that one share paid 110. The market cap was just increased by $10 billion. It's like phantom money. It's just a number. It's just that now because someone paid 110, the company is now worth $110 billion. Okay. People have in their accounts a reflection of P&L based on $110 billion. So just because one share trades in GME at, maybe it trades at 1,000, then your 10,000 shares will look like it just made $7 million, right? If you own 10,000 shares of GME, and you'd be like, I'm worth $7 million. You have to remember, and it's it's a stupid little connection in your brain that everybody has to remember, that you don't have $7 million until you sell those 10,000 shares. And if then one share comes back and sells that 110 and says, now I hit the bid at 100, well, then you're, that 10 billion just gets wiped out. Or if it goes to 1,000 on 1,000 shares, and then everybody's account balloons to be worth X millions, and then another 1,000 shares knocks it down to 300, then that all disappears and evaporates. That by itself could cause a lot of, I always talk about cradling your mind and making sure that the mind is okay. Seeing that can cause a little bit of disconnect, what do you call it? The plug goes out, and your mind starts acting a little crazy. It's important to understand that there's likely no real buyers outside of the shorts. The shorts are the buyers. So when the shorts are done, there's no real buyers at 250, 200, 150. So again, the scenario is that they clear out the shorts one time. Maybe it's today, maybe at 3:45, 4 o'clock, it goes to 500. Okay. And at the end of the day, you get a notice from the world puts out a notice saying, what we talked about. You can't have the leverage in these 30 names. You can't trade options unless you have 10,000 in your account. That 500, that next print tomorrow is everybody, TD Ameritrade, Robinhood, E-Trade, Schwab, they might not open up until 10 o'clock in those names, or they might go, oh, it's, the systems are down again. The systems are down. And meanwhile, the stock is opening down because there's some people that will be able to sell. The stock goes from 500 to 300 where it is now. Then the next stop is 150 and the next stop is 100. And now it's trading 80, and then it opens up and everybody's account gets wiped out in like a flash. Okay. So this is an incredible game. It's an incredible game to play when this is happening, but you cannot not understand the risk and position yourselves. And if you understand it, and Marco, I tell you every time, you can only go to bed thinking that you did the right decision, that you assessed the risk reward. You now know all the information of what could happen. Somebody might say, nah, that'll never happen, which I think would be wrong, but maybe it's only 2% of the time. Maybe it's 5. Maybe you read or you listen to what I'm saying and you say, nah, highly unlikely. I'll wait to 1,000. It's either I'm going to make or lose it. I'm going to make 7 million. I'm going to lose. It's easy to say that. What happens is that a statement like that becomes a disregard and a lack of respect for money. And let me tell you, it becomes very difficult to handle when you've had X millions and then you give it back because you really thought, why did I even think? I just got too greedy to make that last bid. There's this element that is this, the crowd is working, and I want them to keep doing whatever it is that they're doing, however it is that they figured out to make money. That's not the problem. The problem is it's starting to become a little bit unstable for the rest of the world. Okay, for the rest of the world. And that's when the Fed is going to say, you know what, let's pause this for a second. We'll let you guys play around. We're going to, come back, everybody come back in April, May, and then you can play around. When that light switch turns back on, forget it. People could lose half their accounts. If they're leveraged by 50%, you took $3,000 to $100,000 and you're leveraging that to 160, 170. And in one day you lose 50, 60%. Your account's wiped out. Your account is literally wiped out. You lose 50, 60% of 170, it's $100,000. So this is, again, it's very, very, very important that the young investors understand that this is the impossible. This is what doesn't sound like it could happen. Trust me, it didn't sound like they can tell you. By the way, just imagine someone says you're not allowed to short a stock. Imagine, or you're not allowed to buy a stock. You would say, what do you mean? It's my right. I can buy any stock. They can do whatever they want. They can do whatever they want to calm it down or try to calm it down. So that's what I was saying. The only thing that I'm saying right now is if we could, what I'm saying is if it becomes unstable, WallStreetBets is doing a tremendous job in 20 names. It's not the rest of the world, right? But when the rest of the world is affected because 10 hedge funds who have $10 billion each, it's 100 billion, start, messing around with everything else, and the volatility is increasing and things are moving around where you can't catch them, it becomes a problem. It becomes a problem. Let me give you an example, just to put things in perspective. In 1996, 7, the long-term capital, you know how much capital they had? They had $3 billion. Now they were leveraged. They were trading these bond spreads into hundreds and hundreds of billions of dollars of leverage, but they had $3 billion in capital. Nothing. I mean, what's going on right now is, WallStreetBets as a group might have made $3 billion in the last 7 weeks, 8 weeks. I mean, think about this is starting to become real, and WallStreetBets might as well, if they're all trading in a crowd, might as well be as big as most hedge funds. I can tell you that much. As a crowd, they're bigger than most hedge funds. So there's something really going on here, and I don't think that the Fed, the authorities, I don't think that they like that because it's not controllable. And so we have to make sure that we understand, this is the path. It's getting narrower. It's like, it's fun. The party's going. What I'm trained to do is look for the exit doors and say, you know what? There's only one exit door. And, I see already a big crowd around there. How am I going to get out of this? So that's what I'm just trained to do that, and trained to sort of assess the complete risk and the complete reward. I get if it goes to 1,000, people are going to make fortunes, but in the meantime, something bad could happen, and you have to manage that. Next question here. Do you think sharks might be trading less and are harder to spot in the UA right now? 100%. Part of what I was going to talk about today, it's going to be a little bit difficult to do it this way, but the amount of options that are trading in the front 2 weeks is disproportionate to the total amount. It's just, it makes up everything. The amount, not only that, but then the amount of options in 20 names is supersizing everything. Not only that, hedge funds are getting hurt. And so what are they doing? They're in the position of, okay, let's take back some of these shorts. Let's reduce some of our risk. You take back some shorts, you also reduce some risk. The computers, the algorithms, they're doing the same. They have trillions of dollars that they're floating around. They're 80-90% of the volume each day. They are reducing risk. Okay. They are saying, okay, we got to be very careful with these shorts, reduce those, which means we're going to take those notionals down, which means we're going to take down some of the long stocks. All of this could cause the amount of trading after it settles to calm down a lot. After 1999 bubble, there was a period of time where volumes came way down because everyone hunkered down and said, let's try to figure it. Not until it was all the way down. There was a crash. There was a mountain, and then on the other side of the mountain, it was a period of a couple of years going up, and then probably a year getting all the way to the bottom. And then you had 2-3 years of not that much trading. You had knocked out a lot of the active investors. A lot of the people that had leverage were knocked out and just said, okay, we're going to become a value investor. So, I would say that it could affect for sure. It could affect for sure how the hedge funds trade options, how they think about them. They might also be getting more as volatility comes down. They might come down. They might reduce their notionals, and they might get long the options. It also could mean that they will only use options when they have more confidence in the ability to pick the right one and to use them. So these are things that how it could affect it. There's no doubt that volumes could come down.
Mm-hmm.
Go ahead.
All right, there's the next one. Do you see
options harder to trade? Can you show us an example, like setting stuck cotton hack and you making only $1 in puts or something, Sarah? Yeah, and I see actually because I'm looking at the comments.
Mm-hmm.
So I don't know if I guess people are saying, someone is saying what? That I don't know. I would say that if someone says that, I want to be clear. I don't think WallStreetBets is doing anything wrong, and I don't think that like I said, this is something that they're not doing anything wrong at all. However, that doesn't mean there's no instability created in the market, and the federal government will step in if there's instability outside of this 20-30 names. 20-30 names with market caps of, you can count the market caps of these 20-30 names. You're talking about hundreds of billions of dollars now. And if if that becomes unstable, causing instability outside, you better believe the federal government was going to step in. Not that anybody's doing anything wrong. It's just that this action, this activity is causing instability. So I don't know if that didn't come out, that came out the wrong way, but I wanted to make sure that's corrected. Okay, are options harder to trade now? Can you show us an example like stock and kind of, well, how about, I mean, just let's take a look at the prices in GME. I mean, that would be a perfect example just to show you, how it's just not tradable, right? You're looking at February options. Let's just say February 19th, expiring 4 weeks.
Wow.
The 150 puts, okay, the 150 puts are almost $60. The 155s, these are all around $50. That means that if the stock goes to, let's take the 150 puts at $58. If the stock goes to 50, you make, what do we say, $58? So the 150 puts are 58, so you would make 42 bucks, $42. So you're going to risk 57 to make 42. That's not something that you're really interested in doing. Okay. Yeah. And even if the stock came down from 311, it's all reversed now. It's almost, usually when the stocks go up, the volatility comes down. And usually when the stocks go down, the volatility goes up. In this case, it's going to be reversed. Right now, the crash is up. And so the volatility is going up because it's crashing up. When it comes down, the volatility is going to go down because it's going back to some level of stability. So that's a good lesson to sort of see. So you will make money because of the price action going down, but you're going to get killed because you see these 600, 500 as implied volatility, which is just a number being spit out by the Black-Scholes. That will actually go down possibly to 250, 300. Okay, so you're going to get cut in half on the applied volatility, and sure, your deltas or your direction is going to be up. So that will actually make you'll make some money, maybe a little bit, but the option might go from 50. It might go down 200 points, and the option might go from 50 to 52, and you'd be like, "What? Blown away!" And you know who makes money on that? Citadel. They right now they are basically saying we're not playing around. Like at this point, we're not playing around. And if you want to sell us options, we're going to make the bid offer wider. We'll buy them from you because we're buying and selling because a lot of people buying options. But if you're going to buy options, we're going to come and get our money back, right? We're going to get our money back. So right now, 600, 700 volatility, man, it's you had the Facebook guy, what's his name? Shamanath, Facebook guy. He bought the 115 calls yesterday, something like that. I think he spent like 50, 100 grand. And made a fortune here, not for him, but just made a lot of money. And, that those types of trades do hurt. The 200 calls in GME traded yesterday $1. Today, they're 150. Wow. If you bought those, it's very, very difficult for a market maker to make money on that. It's almost impossible. Okay. I believe it is impossible. Nothing's impossible. I would say almost impossible. They're going to get killed on that particular trade. And there was 100,000 traded that day, yesterday. Now, this is, people think they're slick. They're doing these 1x2s. They're doing like the 150 call, sell the 300 call. All of these could just cause that 300 call could just catapult the market makers because they're short what's called gamma, can catapult it to 450, 500. So what they're doing now, you could see, is that they're widening the bid offers. They're forcing you to pay a lot of money just to trade the bid offer. And then they're raising this vol because more people are buying options in these names. So they're raising it to levels that are unheard of. Okay. Because people they're just buying it because it's $8 and I think it can go to 30 or 40 or whatever. Well, you get one bad day or one bad, a situation where they reduce the leverage, and you're going to see all of these vols collapse. And anybody who's long these puts may not even make money if the stocks go down, and the calls are going to get smoked because, there's no more leverage to actually keep buying them. If they don't allow people to, if they have a limit on the amount that people can, on the dollar amount where you have to have, got to be over in order to buy options, they can kill people there. So you can talk, these are the powers that be. I'm sure if we're talking about it, I'm sure that the head guys at Citadel are talking to the government and saying, you got to do something. Otherwise our markets are going to go, nobody's going to make an options market when, at 50 cents wide or 20 cents wide, right? And we're going to make them dollars wide and $2 wide, and then nobody's going to trade. And do you want nobody to trade? right? Hey, Robinhood, do you want nobody to trade? Raise your limits. Hey, TD Ameritrade, E-Trade, you want nobody to trade? Because we're the market maker. Citadel is the market, and we could just make these markets wider as we want. We're getting hurt here. I mean, nobody's crying for Citadel. I told you yesterday, they just announced they made $6.7 billion. So nobody's going to cry for them, but they're certainly not going to stick their neck out and start making very liquid markets when, they can get hurt with, a few $100 million on one trade. Right. So that's what I would say about that. Okay. You said that it is definitely harder to spot sharks now. Does that mean if we spot one, they are more certain to trade in the idea? I would say yes and no. Okay. They are very, right now, I'm sure at every hedge fund, they're looking at every single name in their book. They're trying to reduce risk. And part of reducing risk is selling their stocks that they own, because let's get it straight. That's mainly what they're doing. They're long. Most of these hedge fund managers have 100 names and they're selling maybe 90 of, I'm sorry, they have 90 of them without options and 10 names with options. Maybe some of them, it's only one or two. So in order to reduce risk for them, it's reducing the stock. So they're going to reduce some stock. You might see some people saying, I'm very comfortable with my name. The volatility is up across the board. I might just start selling calls at the money calls because it's so high. And it's like it gives me a cushion on the downside. So you might see more of that. You have a situation where you're not going to know if someone's buying a call option, whether or not they're actually reducing stock. So it becomes very difficult now in this sort of over the last couple of weeks to start figuring out what really is the motive behind buying that option. In a normal environment, you can sort of take your, now we're in a crazy environment. You got to think a little crazy. Like, what are people doing? Like, why? Before coming on the podcast, I'm thinking, I try to put myself in a hedge fund situation right now and say, what am I thinking? Well, what exactly would I be thinking? I can tell you that the first and foremost rule number one of any hedge fund is to make sure, capital is safe, right? Make sure capital is safe. Have good bets, but make sure capital is safe. And that's what they're thinking. Mm-hmm. Is it emotional? Could be in some places. It could be banging, taking a computer, throwing it against the wall, and then saying, hey, get me another computer here. It happens. Trust me, it happens. Even at the investment banks, taking what was you're sitting on a desk like this. If a customer got me into a GME position, I couldn't get out. I'm down every day. I walk in, I'm down $1 million, $2 million, $3 million, $5 million bucks. I'm taking my keyboard every day, literally cracking it, throwing it, and then joking around. Another trader would be like, medic, or like new keyboard, or yell something out. And meanwhile, because someone's very frustrated or whatever. So right. Like at these places, everybody's very corporate and business-like, but in times where you're losing a lot of money, the frustration gets to you, it could happen. Some places, I would say Goldman Sachs, it's quiet. Probably today's like the quietest day of the year. And some other days at a smaller shops, you're going to see people yelling and getting upset or popping the champagne, right? Or, having drinks on the desk. We made a fortune and there you go. So, so that's what I would say. So it's about trying to think about what the powers that be are going to do. That's the next step. You have to be cognizant of that. I think, look, I think it's hard for me to actually go through some of the stuff not knowing or not seeing. So I think, we're at 40 minutes today. I apologize. What I would say is to take a look at the momentum names. What the gist was going to be was that I think it's interesting that some of the EV names are not performing well. The EV cars, the Chinese ones, the NIO, the Li, the XPEV. I think there's, I think there's something going on there. I think it's something to think about and something to look at. That particular sector. Blink is down. There's certain names that are not trading well, and I would look at those names. If you're momentum and you're in this, you're one of these 30 stocks and you're not doing well today, maybe this is a bad horse, a weak, sick horse. What else? Maybe there's a couple of questions I could take that I can sort of answer. I'll look at the chat here. I don't know. Do you see anything else? Last moment. Here's one. Simone, I owe you an answer on something else. I know you emailed me. How are retail investors able to push the price up so much after hours? Not many platforms allow trading out of market hours. Okay, that's a great question. So when I see that, when I see Simone, great question, because it happens in GME a lot. In a short, what happens, this is actually when you're shorting stocks, you have to borrow the stock. So people, I think, are now aware because of all this how to short a stock. If I want to short GME, I have to call up my broker, say, can I borrow 10,000 shares of GME? Yes, great. Now I borrow that. I'm going to be charged a fee every day. That fee now is very high. Although now it's not existing, you can't even short the stock. So if I was allowed to, I would take that fee. I say, okay, I'll pay you that fee. And now I can go short the stock, which means just sell it. I didn't own it before. I borrowed it. I'm selling it. If the stock goes down, I buy back. So that is how you short the stock. Now, the flip side is if it becomes very hard to borrow, my prime broker can call me up at 3:45 and say, I don't have that ability to lend you that stock anymore. So my broker calls me at 3:45, 3 o'clock. Sometimes if you have a big position, they're already warning you at 12, 1 o'clock. Say, we're getting call-ins. We're getting the people who lend us, because the brokers, they're not lending you the stock because they don't have it. They go and borrow it. So there's a triple line here. There's someone who's long the stock. In this case, maybe it's Ryan Cohen, let's just say. He's long the stock, or Vanguard, and they're long a lot of stock. And he says, the prime broker calls Ryan, said, can you lend me stock? Now, Ryan might have said, sure, let's call it a month and a half ago. Sure, you want to borrow 5 million shares? Go nuts, right? And he allows everybody to short the stock, and everybody's shorting his stock, right? Now, he comes back and he's, licking his chops, and he calls up the same broker that he lent it to. He doesn't know who's shorting it, but he calls up Goldman Sachs, who tried to borrow the stock. And he said, sure, no problem. He calls up Goldman Sachs and he says, you know what, Goldman Sachs, I changed my mind. I don't want to lend it out anymore. Goldman Sachs, no, we'll pay you. We will pay you money to, nah, I don't need the money. I don't want to short the stock. I'm calling it in. So Goldman, is going to try to pay whatever they can and try to get Goldman is the broker. They're going to try to get a price that they can keep the stock. And, maybe in this case, Ryan Cohen says, no, I want my 10 million or 20 million shares back. And I want them in my account. And I want those pieces of paper. I want that on my desk. I want my stock certificates on my desk. I want to make sure nobody's shorting my stock right now. So what does Goldman have to do? Goldman is then, again, making those calls to me and saying, we're having trouble getting you a borrow. And we're just letting you know that at the end of the day, we might have to do something here, which means that I'm at the risk of buying the stock at whatever price. Think about that, at whatever price. At the end of the day, a lot of these prime brokers, they call up customers at 4 o'clock and they say, we're getting called in, because maybe Ryan Cohen or whoever it was, I'm just using his name because he has a lot of stock. Maybe he says at 3:50, calls Goldman Sachs. He waits to the end of the day and says, call it in. I don't want to lend my stock anymore. And what happens? Well, then Goldman says, they try to do their dance and it doesn't work. Goldman calls up me and says, you're short 1 million shares. You need to buy back 1 million shares now after hours. And I say, that's impossible. How am I going to buy 1 million shares after hours? Well, it just so happens that we have an offer at $300. And I'd say, well, the stock is trading 150. He will sell you 100,000 at 250. That's the offer. There's no other offer. You want to buy it in the market, go ahead. But he'll sell you 100,000 at 250 to get you started. Boom, it trades 250. Fine. You don't have a choice. You're legally obligated to get out. And so in these scenarios, that's why in the after hours, you start seeing these things jump significantly, because there might be call-ins. The brokers are calling these borrows back. And at 4 o'clock, there's no choice but to take the offer. Who's on that offer? Who's willing to sell? Maybe it's not, in this case, not Ryan Cohen, because he'd have to think, but maybe it's a big owner of stock that has 1 million shares, says, I'll sell you 1 million. And maybe it's, WallStreetBets people at the end saying at 1,000, I'm at 1,000. What do you want to do? No, I don't want to pay 1,000. You don't have a choice. If that's where the liquidity comes, then that's where it goes. So it's this game of chicken. But I think when I see that after hours, that's what I'm thinking. You see a lot of these short names yesterday jumped in the after hours. Yep. Possibly because there's call-ins. People are saying, I don't want to lend my stock. So that is also something that might have been thought of 2 months ago. you allow the lending, you allow people to lend it. You have a 3-month, maybe there's a 3-month lockup, and say, sure, we'll allow you to short the stock for 3 months, and then you have this coordinated attack to just start buying, and then right at the time 3 months is up, yep, call it back. I don't want to lend it anymore.
Wow,
that's the problem.
nice.
Okay, that's a good question. That's a good question, Simone. And I do owe you an answer on your email. Sorry about that. All right, let's call it a day. We almost made an hour, and I hope that helps. Thank you very much. And Marco, let's talk tomorrow.
Sounds good. Thank you, Felix. All right.
All right, be good.